The next housing crash. 5 things banks don't want you to know. Hook. The housing market crash has been the talk of the town for a long time. Some say it will happen and some say it will not, but banks will be involved in both possibilities. Here are some facts banks don't want you to know. Main script. The property market went from hot to cold in a matter of only a few weeks. Real estate agents state that the phone, which had frequently been ringing nonstop, started to ring only a few times per day. Numerous potential purchasers had been attending open houses, but suddenly some of them saw no visitors. It's no accident that mortgage rates rose to their highest level since 2009, at about the same time that Grunstein observed a change in the housing market in mid-May. The average monthly mortgage payment increased by more than $500 as a result of rising rates and record high property values at 37% increase since the beginning of the year. Many real estate brokers all around the nation claim to have observed a sudden halt in activity in the property market. What follows then? The world was becoming more global, so the idea of purchasing a home seemed silly. The stock market was holding up well, and home values hardly changed. Although purchasing a home wasn't as appealing as other investments, it completely altered everything. One of the best investment choices you'll ever make, according to the Fed, is purchasing a home. Actual price increases exceeded 20%. The stock market has increased significantly but is now in danger of collapsing. Compared to its pre-pandemic baseline, the S&P 500 has increased by around 12%, while home prices have increased by about 20%. But it is gradually shifting. Since the home market is unique from the stock market, where anyone with a few bucks in their pocket may buy stocks, it is not sustainable to buy a house and sell it in large quantities. The average person's biggest purchase in life is often a house, so the market hardly changes by more than 1 or 2% annually. Some economists have cautioned us against another housing crash because the last time home prices climbed so dramatically, it led to the worst financial crisis in the last few decades. As a result, our home values are finally falling as we observe an increase in such news. What if a new housing crash just started? Will the current housing meltdown be as severe as the one that occurred in 2008? The first thing you must do is keep an eye out for market activity and information. Banks always look for opportunities to profit from a scenario, but if you don't want to be used by them, let's look at some facts that can support you in this difficult situation. The Federal Reserve dropped an atomic bomb on June 15th when abruptly raised interest rates by 75%. The housing market will be severely harmed by this hike, which is the largest since 1994. It can be tough to expect anything to decline when it's climbing so quickly, especially given the serious harm that the Fed's previous interest rate increase already did to the housing market. But let's examine what is occurring locally. More and more house sellers are reducing their prices in some locations, claim experts at Realtor.com. This is definitely a severe situation because just a few short months ago, we had incidents similar to this where buyers were willing to overpay for a home in order to bless the person who would be willing to sell it. It appears that the days of home purchasers placing bids have ended. As we go into a new era, retailers may need to engage in a pricing war to draw in customers. Redfin said that at the end of May that almost 1 in 5 purchasers had lowered their asking prices, which had not happened since October 2019. Behind that, there is a clear explanation. Mortgages are used to buy the great majority of the homes in the U.S. More specifically, more than 60% of residences have mortgages. The amount of debt that borrowers can take on with their present income decreases as a result of the Fed raising interest rates and increasing the cost of borrowing money. A smaller mortgage reduces their options, which lowers demand, forces sellers to cut their asking prices to sell, and so on. The credit rating company Moody's provided Fortune with the unique access to its most recent examination of the U.S. housing market. They looked into whether local residents could support local homes with their salaries. National home prices are about 25% inflated now during the first quarter of 2022. This is an increase from the fourth quarter of last year, when Moody's Analytics found that the national home prices were around 20% overpriced. It's only a matter of time before demand for homes declines noticeably when the difference between housing prices and what people can afford is too great. When that occurs, you can tell the market is overvalued. Because of this, analysts at Atlas Research discovered that more than 25% of the homes currently on the market have reduced their prices. In its data, Zillow also noticed a similar pattern. The price cap rate for properties listed on Zillow was 6.4%, the highest weekly proportion in more than 5 years. The path of the market is ultimately determined by economic laws. The supply of dwellings at last reached its prepaid level in January of this year. Mortgages remain alluring, nevertheless, which encourage purchasers. But today, the market has undergone a significant transformation. The market supply of homes has increased significantly over the past 12 years, not just somewhat. When the housing market was at its pace after the 2008 financial crisis, it was in May 2010. Of course, there are numerous reasons for this, but one of them is undoubtedly the seller's realization that their prices won't continue to rise if they hold on to their assets. The upheaval has already started, and they have achieved their peak. Tomorrow might be too late if you don't sell today. The supply of properties is at an all-time high due to the desire to sell before mortgages become unaffordable. That's actually a very worrisome indication of the state of the market, since it shows that the lack of homes on the market wasn't caused by our inability to build more homes, but rather by buyers who were reluctant to sell because they were waiting for a better chance. The quantity of homes on the market that sellers held consciously is the subject of discussion. If that amount is excessive, the market may be oversupplied with homes that have yet to have little to no demand, which could easily result in the kind of calamity we saw in 2008. Over 10 years later, the 2008 crash is still being felt. The issue is that the U.S. economy is not prepared to handle another catastrophe of this nature. The economy is already being impacted by the problems of the nation has been dealing with for the past 2 years. Mortgage rates have already risen over 6%, and in only the past 6 months, the actual cost of purchasing a home has increased by nearly 50%. Since 2008, that has represented the highest mortgage rate. The largest production swing since 1981 can also be attributed to the 3.2 percentage point increase in mortgage rates over the previous year. As a result of mortgage rates being held steady, many prospective borrowers who couldn't satisfy the bank's required debt-to-income ratios are no longer eligible for loans, while buyers who were underestimated will just have to pay more money. For a few more months, we won't fully understand how much demand is likely to decline over the next few months. And if the Fed raises interest rates once more to over 2%, as some experts predict, by the start of 2023, things might get really bad. Of course, some experts are telling us that the crash won't occur, and I sincerely hope that's the case. However, analysts from that expect by the end of the year, the average third-year fixed mortgage rate will increase from 3.1% to 3.3%. Since there are so many variables affecting the Fed policies, we cannot state with certainty what to anticipate over the next 12 months. The U.S. is attempting to strike a balance between handling its domestic affairs and criticizing Russia's invasion of Ukraine, which is driving up prices globally. Rising rates won't make a significant difference on their own. Home prices are unlikely to decrease if inflation keeps increasing, because it will just drive up the cost of building new homes, which will at least hold prices steady. The Biden administration has already made it known that the president will travel to Saudi Arabia in order to persuade the nation to expand its oil production in order to cover the gap and finally bring down oil prices. Can he be successful? Since oil-producing nations are making more money than ever, I don't really believe that. The outcome of the Nigel discussions, though, is still up in the air. Therefore, the direction in which housing market will move depends significantly on external factors in addition to the Fed's policy. Call to action. This ends the video for today. Tell us what you think about the housing crash. Will it happen or not? Like, share, and subscribe to the channel to know more.